Hey everyone. We're going to be kicking off in the back. If you're here for Stack and Sip, we'll be kicking off in 10 minutes. Grab your drinks. It'll be a great event. Even if you're not here for it, everyone's more than welcome. Be good.
See a green light and that's
All right, cool. Oh, I'm so sorry. Hello, happy Thursday. Apologies for the delay. We are very excited to be having this event with Daily Stack and Bitcoin News. We'll get into some really good topics. It'll be a fireside chat, but if anyone is having any confusion with terminology, questions throughout, please feel free to raise your hand. We'll have a roaming mic and just enter the conversation. It's really meant for community-based, interactive, and for everyone to feel involved and make the most out of it. So thank you everyone for coming, and make sure to get some drinks.
Cheers. All right. Thank you everybody for coming out. We are doing our inaugural Stack and Sip. So if you guys don't know, we run the Daily Stack. We do a live stream 5 days a week, Monday through Friday, 12:30 p.m. Eastern. We talk about Bitcoin, of course, markets, AI, and this is the first time we're getting together in real life. So I want to give a shout out to my fellow Daily Stack guys. We got Jody over here, came out from Oregon. He's on Wednesdays. He does a lot of AI, Treasury Talks, very cool show. He's got an AI agent that sends out Bitcoin over the Lightning Network. And then we got this guy over here, Avi. He's on Tuesdays. He does markets. Great options. If you need option plays, talk to this guy, right? Cool. And we are joined by a very esteemed panel tonight. I'd like to introduce Himanshu Sahai, the co-founder of Arch, a Bitcoin-backed lending platform, and Steve Baum, the managing director of CBIZ Crypto. Gentlemen, how are you guys doing tonight?
Fantastic. How are you?
Doing good, yes. And Steve?
I didn't get one of the pancake Bitcoin stacks, so I'm a little upset, but besides that, I got a Guinness, so we're good.
We're good. So the theme of tonight's discussion is stacking through the storm. We've got a lending expert, a tax expert when it comes to crypto, Bitcoin, and we want to figure out how to best deal with a bear market. Are there tips and tricks? What tactically can we do to wind up with more Bitcoin at the end of a bear market than when we started? So first, from the audience, raise your hand. Have you guys been through a Bitcoin bear market before? Okay, yeah, you guys have. All right, nice. So my first question for you two is this actually a bear market?
Yes and no. So if you look at the last two bear markets, 2018, 2022, it was very different. It was very sentiment-based. There wasn't a large bid through the bear market, and it was very much macro-driven as well. Today, it's very different. Yes, it is still macro-driven. Yes, it is still sentiment-based. But there's a large institutional bid. There's an ETF bid. There's the Treasury bid that's long-term. And I think we've gone from Bitcoin being a trade versus Bitcoin being a store of value, which I think changes the framework around what Bitcoin really is now. And that changes how Bitcoin is contracted, which is less so than previous bear markets. I think this is the first time where we see the inflection point in Bitcoin, where it goes from being a macro-like, stock-like asset to actually being something that does still contract with macro, but is becoming a flight to safety.
Wonderful.
We're definitely in a bear market, okay? Look, it's like clockwork with Bitcoin, right? We talk about how the halvening impacts Bitcoin every 4 years, and we've seen this story play out time and time again. And we clearly are back down to about almost 50% of the value of the all-time high, right? We're not there yet. Maybe we get there soon, right? But it's definitely seeing that bear cycle. The difference in this bear cycle that I've seen compared to 22 is when you looked at 22, you had all of these systemic failures within the centralized system of crypto with FTX and Celsius and all these other institutions. Here, what we're seeing is actually forward trajectory of regulation, market structure, and actually positive momentum with the Bitcoin industry. So I actually think that we're in a way better situation now than we were in the last one because you have a lot more clarity as it relates to where the regulatory environment is.
And as you mentioned, we are in an interesting macro environment, right? It's the first time we're dealing with tariffs since Bitcoin has been around. We've got a brand new conflict with the Strait of Hormuz being shut down and potentially energy being threatened here. How much should Bitcoiners and crypto holders in general care about macro when it comes to this asset?
Well, I think they should use it strategically, right? Like it's a cheap time to buy Bitcoin. If you look at Bitcoin as a store of value that you want to hold, the way you compound wealth is you combine exposure with time and market and with a smart entry point. This lets you counteract the lack of time and market you may have had in the past by actually getting in now. This lets you get a low entry point and increase exposure. So I think if you're looking at Bitcoin as something that you think is going to be a store of value for you long term, this is the best time to actually use that asset strategically, use the existing Bitcoin you have to get more. You can do it through a loan or some other way. And to really compound your exposure. At the same time, looking at where prices go, being a bit more pertinent than you would be otherwise. I think as we see the pain from what's happening in the Strait of Hormuz, we'll probably see some quantitative easing, and that is going to bode well for interest rates, and it's going to bode well for just more assets being purchased, which Bitcoin would then benefit from as well.
Are they going to print?
I mean, I don't know if they're going to print money, but I think when you look at Bitcoin as an asset class today, what we know is that it's at around 1.4 trillion today, okay? If you believe in this asset class and you expect it to be a store of value for the future, which I do believe because younger individuals believe in this more than anything else, when you talk about investing in Bitcoin versus US Treasuries versus gold, the younger generation is very, very invested in Bitcoin as a store of value. And if Bitcoin only gets to 10 trillion, right, that's a 5x, 6x multiple of where it is today. Okay, that puts us at a $400,000 or $500,000 Bitcoin. Maybe it takes 3 or 4 years to get to that allocation, but institutions will allocate once market structure is fully approved in DC. The Clarity Act is supposed to be passed, hopefully soon, but once that's passed and institutions can allocate capital, the market cap will drive up closer to 10 trillion pretty quickly. So once that occurs, to me, this is the best store of value you could be. However, it is no longer the same type of asset class that we saw back in 2014, 2015 as like this moonshot investment where you're going to get 2,000%. Right now, we're talking about 7, 8x or something like that over a 5-year window. You could probably do better than that in a startup or in a stock on the NASDAQ. So it's no longer this huge volatile asset that's going to go up in value, but it also is going to reduce the volatility on the downside, which is going to allow institutional paper to start to print more value around it, which is going to make it more like a savings account to allow you to be more confident that you could put Bitcoin into a position and allow it to grow over time. So to me, it operates more like a savings account that you're confident that it's going to grow over a 4 to 5 year period. And because it's so low, the downside risk is kind of almost mitigated right now.
And you speak of Washington, D.C. and the Clarity Act. You were down in D.C. just this last week, were you not? What's the word on the street?
So I was there for an event. We're part of a group called the D.C. Chamber, Digital Chamber down there. They basically are a lobbyist group in D.C. for all digital assets and blockchain. And this is one of the most influential years that I've seen it. Pretty much every congressman, senator was in the room talking about this. And look, I'm not in the rooms writing this bill, but what I've heard is that they're very close. They're in the process of finalizing the details of what the bill is going to look like. This will be one of the most monumental pieces of legislation that we ever see in our lifetime because it will allow crypto as a general asset class to be basically legal in this country and not reversible. That is huge. Okay, under the last administration, people were scared to enter this space because they didn't know if they were going to have to deal with regulatory enforcement, criminal action, civil action, all of these things because there wasn't a framework that allowed us to follow. Now, if a framework is passed that is a legal bill that allows us to follow that framework, we then can move forward and people could build technology, people can invest in this asset class without the fear of regulatory enforcement. That is major. And that will allow institutional adoption to come very quickly, and they will slowly start to allocate to the class at a pace that we've never seen before.
And Himanshu, when it comes to you and Arch and your business with Bitcoin lending, does this law have anything, does it affect you guys in any way?
Yeah, it's a net positive because so from yesterday's SEC guidance, we now know that Bitcoin, Ethereum, XRP, Sol are clearly treated as commodities, not securities. We know certain actions like wrapping and staking are not treated as securities transactions. That has a huge impact for taxes, which you guys probably are quite deep into. But a loan is in some ways, it's a way to avoid taxes, and it's also a way to preserve your upside. So it does have an impact for our borrowers, and I think it's a net positive for the industry. I think if we know exactly what we're dealing with, we can then build other products around it, which we know we have regulatory clarity on. The reason we didn't launch a yield product 2 years ago is because we didn't know whether we would be fined the way BlockFi was fined in 2022 for the exact same product.
All right, so let's talk about lending. So I'm sure plenty of people in this room have Bitcoin, but now we're down a little bit, right? And so it hurts to sell. It always hurts to sell Bitcoin, but especially when you're down 40% or so. So when does it make sense to sell, or just to hold, grin and bear it, or 3, take a loan against it?
Yeah, I look at that as 3 layers of the same coin, right? You sell it when the use case of that capital is worth more than the upside of the Bitcoin and the downside of the taxes that you'll pay by selling it. Yes, if you can do some tax loss harvesting by selling, great. If you have better use cases for the capital, sure, go ahead. If you know you'll be able to buy back in cheaper. The borrowing use case is quite simple. You have an asset that's appreciating. You have an asset that's your store of value. It's like your house or some other asset that you may have, and you want to make it productive by using it to fund your other investments, your lifestyle, whatever it is that you do. Our use cases are extremely rare. We've seen people, we've funded so many houses in the country, so many coffee shops. We funded a guy that has a sailing business in the Turks and Caicos. We funded many people that do the STRC trade. So you borrow lower and you invest in STRC, and that's risk-free cash. We funded a private racetrack. We funded a Hollywood movie, everything. There's so many use cases, but where the use of funds is productive, it makes a lot of sense. A lot of people who live on the Bitcoin standard don't have cash most of the time, right? They have a lot of Bitcoin, but not cash. So they should be using loans in a strategic fashion, low LTVs, to really fund their lifestyle, defer your payments, which you can do with us very soon, and just live off the CAGR of Bitcoin. Bitcoin's CAGR over the last 5 years is 31 to 35%, depending on the date you track it from. Our loans are single digits, so you're always going to be making more Bitcoin than the interest that you're being charged, which you can defer anyway. So it just makes sense to have an appreciating asset fund cash, which is not an appreciating asset.
And Steve, taking a loan out against your Bitcoin is not a taxable event, right?
Correct.
So are there any second order or third order effects that we should be thinking about when you take a loan out against your Bitcoin when it comes to taxes? Or just
So all right. So when you're doing a loan, I don't know the specific structure here as how it's handled, but there's a typical general rule of thumb as it comes to taxes where you do not take what's called a basis adjustment when you lend an asset of in-kind structure. So as long as it's the same asset and you're expected to get the same asset back, then there is no basis adjustment or taxable event. If you were to give, let's say, Bitcoin to fund a business operation and maybe you get the Bitcoin back, maybe you get Ethereum back, maybe you get something else back, well, then it could be a taxable event. So there is some nuances. I don't want to say, yes to everything. But what was the question? Is there any strategy there?
like, are there any second or third order effects that you should be thinking about?
Debt, this isn't new, right? Debt is always a good way to structure any sort of business by being able to take tax deductions off of interest payments and other things related to that debt. So, debt is a way to build wealth. As it relates to Bitcoin lending, I do think this will be the future of lending because Bitcoin is probably the best asset to lend off of when you compare to other asset classes. Right now, the primary asset class people lend off of is real estate. Now, real estate, yes, it's an appreciating asset, good asset to lend off of. The problem is, from the banking side of it, when you start to talk to the institutional side, there's more risk related to lending on real estate due to the fact that each piece of real estate is completely different. Every piece of real estate has its own unique issues or problems or maybe benefits, while Bitcoin is truly fungible. So when you tried to lend off of Bitcoin, you're getting the same asset the same time over and over again. And I think over time, when the asset class becomes less volatile, you're going to see Bitcoin as the primary collateral asset that banks want to lend off of because they know that this is a fungible asset that will ultimately either hold value or appreciate in value over time.
And so both of you guys being in lending and taxes, it's very nice to be in your line of work when nothing goes wrong and it's all hunky-dory and your clients are happy and don't call you at night and you're completely free of any worries. But you guys have both been in Bitcoin for over 10 years now. So what are some of the most common and expensive mistakes you see Bitcoiners make, especially during bear markets?
People often over-lever themselves. So my first point of recommendation to anybody is never ever use your full stack. If you have 10 Bitcoin, don't use it. Use 8, use 6. You need to make sure that you're never a forced seller. The biggest mistake people make is they become a forced seller. So what that means is you are not able to meet a margin call, not because you didn't do a good loan, it's because the market went down, but you should have the funds to actually meet the margin call, whether that's by adding cash or by topping up some collateral. So that's the first thing. Never lose your stack in a structure that you actually are using to be more productive. As long as you've handled that, you're not going to be in a bad situation. We've had a ton of liquidations in February, but a lot of people who did have loans that would have been liquidated didn't need to get them liquidated because they actually had the funds to make the payments or to add more collateral. And I think that recommendation is just smart leverage. If you're levering up smartly and you're using it to invest in a productive asset or you're using it for use case that you know you'll be able to meet in the future, then I don't think there's any issues. And as a result, I don't think there's a right or wrong time to borrow. The use case at 60 or 70K is maybe different from the use case at 120, but if you handle it well, you're not going to be in a negative situation in either of those cases.
And Steve, what are some
what was the question?
some of the biggest mistakes that you see?
Look, the bear markets, right? Obviously, my biggest mistake is I never bought enough, right, in the bear markets. But I think, to be honest, looking at every bear market that I've been part of with crypto, you really kind of look back at and you say, I should have built more. And I think when the noise goes away, there's so much noise when we hit these all-time highs. Every single time, there's noise. Everybody's in this. Everybody wants to hear about it. And then the noise goes away. Bitcoin's dead, right? That's always the media. Bitcoin's dead again. And that's the best time to build, in my mind. That is the time where you really make the connections, you really build the relationships. And that's what excites me about these bear markets is like the noise just goes away. You know, a lot of people in this room are probably going to go to Vegas in a few weeks. I'll be out there as well. You know, we're going to see who the real players are in the Bitcoin space because the people that are coming this year are the people that want to be in it. You went there last year. It's like you got all these, you know, people coming there. Oh, Bitcoin this, Bitcoin that, you know. But this is who's actually building. So to me, it's not building now, and it's not building the relationships now and waiting for the peaks to build those relationships.
And the big theme of Las Vegas was Bitcoin treasury companies.
Yeah.
And so those had a meteoric rise and quite the crash in the last 6 months or so. Both of you guys deal with Bitcoin treasury companies in different ways. I'd love to hear your experience working with that particular set of businesses over the last year.
Yeah, so Bitcoin treasury companies, I think the idea behind them is quite sound. They're using Bitcoin as a reserve asset versus cash. They are flipping the script on how a company is built. They're starting off with a huge base and then building an operating company underneath that, or many operating companies. The issue many faced is they initially used various forms of publicly issued equity and debt, which were cheap, and that's feasible when your MNAV, which is a measure of your Bitcoin holdings versus your stock, is positive. Now, the issue most felt is that when the stock came crashing down, those numbers became negative, and they could no longer access the public debt. So now their Bitcoin is their only collateralizable asset, and a lot of them are now focusing on Bitcoin-backed lending as a use case to make the Bitcoin more productive, get the MNAV numbers back up, and actually be able to use that cash to build a business underneath. There's no longer the world where you can just have a Bitcoin treasury company which just holds Bitcoin and does nothing else. It has to be productive, and the productivity starts with the Bitcoin that they're actually holding, and then it flows down to the operating companies they either acquire or build.
Look, so I think the Bitcoin treasury companies are like the exact opposite of what Bitcoiners want. Okay, let's just be honest here. Okay, this is like the anti-Bitcoiner. This is how do we take Bitcoin and make it into a financial product. That's what's happening here, right? These DATs, the digital asset treasury businesses, what we call them now, they are, and this is for Bitcoin DATs, let's say specifically, because there's all these other DATs that I don't know what half of them are doing right now, but they have different strategies, okay? So with the Bitcoin DATs specifically, their goal and their whole idea is that Bitcoin will become financial paper, and that by holding as much Bitcoin as that they have, they will be able to create financial product off of that collateral asset. And this is kind of against Bitcoiners as a whole. So it's kind of one of these things where you look at it and you say, all right, it's good because it's getting allocation to the asset class, but it's also kind of moving us away from this decentralized mindset of what we originally got into Bitcoin. So, so CBIZ is one of the largest auditors of DATs in the whole country. We audit close to 30 of these things. Many of them are Bitcoin, many of them are altcoins, and we're seeing a lot of activity with them right now. They're not necessarily all bad. A lot of them have really good management teams. A lot of them really do want to grow their companies and do acquisitions, strategic acquisitions that monetize other areas. But the most important thing about these DATs is you can't just hold crypto and then think it's going to work. You need to find some sort of cash flowing business that you could attach onto the DAT to allow you to actually cash flow to then create collateral from these assets that you're holding to build in other ways. So it's a very unique strategy. I think that there are some teams out there with some of these DATs that have really good management teams, understand it really well. But we'll see what happens.
And part of this conversation, I want to make it useful for the audience, things that they can do themselves to make the most of the bear market, right? And so in terms of lending, you can borrow against your Bitcoin to accumulate more when price is low. And in terms of taxes, you can do tax loss harvesting, right? How do these two things play together? Which one would you put in front of the other? What is the most powerful to help you grow your stack at this time?
Yeah, I think it really depends. Tax loss harvesting is useful if you have other gains to actually depreciate your taxes against. If you don't, then obviously don't do it. It's a very good time to get in at a lower entry price than you may have been able to in the past, and that you may have thought that you missed. The number of people who have come to me at 100, 110, 120 and said, oh, I've missed the boat. This is your time to get in and actually not miss the boat. As I said earlier, wealth is a function of exposure, time in market, and entry price. This is a time where all three are aligned, and you can actually increase your exposure by getting in at a smart price and reduce the effect of time in market. That's what you should do. And if you haven't bought your first Bitcoin, or any part of a Bitcoin, this is a great time to do it. And if you do have Bitcoin, it's a great time to actually use that to borrow more. We actually have a product called the Bitcoin Accumulator that does let you gain more Bitcoin in a price appreciation scenario. But the underlying theme that I'm trying to hit on is use this time strategically. A bear market is when you can be a smart purchaser, when there is a forced seller somewhere else who's constrained. Use the opportunity to make yourself into a much stronger position. And when the markets continue to rise, you'll be in a much, much stronger position than you would have been 6 months ago.
Wonderful. Steve?
Yeah, it's funny how the human brain works, because I've been in crypto for almost 10 years, and I've always told people, buy Bitcoin, buy Bitcoin. And a lot of these people, the first time they ever bought Bitcoin was when it hit like $120,000. It's like, oh, this is the time. I'm just saying, okay, buy it now. Now we're back at 70. No one wants to touch it again. So it's pretty funny how it works with that. Because people want to believe in the hype and the upswing and all that, and then as soon as it comes down, it's like, it's never going to return, and everyone's scared of it again. So it's kind of interesting, but definitely you got to take advantage of this opportunity right now, because there's so much positive momentum, with the exception of the macro economy right now, with what's going on and all the macro side with the war and the oil prices, etc. Every other factor is positive, right? We actually have a government that wants to innovate here, who wants to allow people in crypto and Bitcoin to do business in the US. We've never had that in the entire life cycle of Bitcoin. So that is a major fundamental factor that is significantly different in today's right now than what we've seen historically. So I think that that's a huge positive thing, and definitely don't miss that moment, because it's going to be so obvious in a couple of years, and everyone's going to be like, oh, I should have realized it.
And for you,
harvesting though, I'll talk about tax. Yeah. I'll talk about the tax side. So if for those of you who don't know what tax loss harvesting is, it's not planting flowers or something like that. So what it is basically when you have a basis in Bitcoin where you pay, let's say, $100,000, and now the Bitcoin's worth 70. If you were to sell that Bitcoin, you would have a $30,000 loss on that asset, right? Now, due to the fact, this is very unique in Bitcoin, which is different than equity securities. There is a rule for equity securities. If you were to sell an asset below cost, you can only take the loss as long as you don't rebuy that back for 30 days, called the wash sale rule. Bitcoin, due to the fact that it's not an equity security, it kind of falls in the cracks, meaning that there is no wash sale rule for Bitcoin or digital assets. So hypothetically, the Bitcoin you bought at 100, you could sell it right now, buy it back 1 minute later, and all you're doing is getting a $30,000 loss. You own the same Bitcoin, and you just reduced your cost basis to a lower amount. And what that does allows you to take a $30,000 deduction on your tax return, but it only matters to, I think someone said it over here, if you have an offsetting gain to be able to allocate to it. That gain does roll forward, except for certain states you can't roll it, but for the federal government you can. Some states allow roll forward on that, but it is a huge advantage to take it. Now, when you sell that Bitcoin when it's worth $500,000 later, you're going to take the gain later. But, tax strategies all defer.
And speaking of tax strategy, the new 1099 DA form is coming out,
Yeah,
right?
who got that? Anyone get those? Yeah, you've been getting them? All right, I've seen a few people get them. We do a lot of work with that. It's interesting with the 1099. So, right now, this year's easy. 2025, 1099s are only required to do for proceeds only. No cost basis is required to be issued at this point. 26 will be cost basis requirement. So 26 can be a problem, right? Everyone is, all these exchanges are asking you to input your cost basis. And so, I think what people don't know is that the tax form, the 8949, which is the tax form that you calculate your gains and losses related to equity securities and digital assets, there's actually multiple different boxes now that they've input. So there's one box that says, I've received a 1099A and it's accurate. Box 2 says I've received a 1099A, the proceeds are accurate but no cost basis. And then the third box is I didn't get anything to report my gains, which is essentially on-chain activity. You are now required to bifurcate your gain loss calculation based on those different buckets to be able to tell the government whether there's an error in that 1099 DA. They will, probably not this year, but next year. I spoke to somebody from the IRS yesterday about this. They will probably start to send out what they call matching notices if you have significant dollar value and you are kind of not aligning with the 1099 DA. So there is adjustment columns that you could put in to try to help you figure it out. But basically, they're just going to use this as a way to just start sending blanket notices. For those of you that were in the industry in 21, they used to do this with what they called the John Doe summons. They would just send out notices to anybody they think had Bitcoin. And from there, they would just start they would start with the exchange, say how much money did you withdraw, and then they would just follow the trail. And they would try to go after you for that.
And this wouldn't be a panel in 2026 if I didn't ask about AI. So, Himanshu, tell us, what is Arch doing with AI, if anything, and does that impact Bitcoin lending at all?
Great question. I can tell you what we do internally with AI. We use it across the board, whether it's engineering, we use Cloud Code, we use Cloud Cowork, we use Cursor Agents. In marketing, we use that as well. My head of marketing is right here. He uses it nonstop to the point where people get scared at what he's using. We use it for all copy, etc. as well. Obviously, with a human kind of overlooking everything. But it's helped us just move a lot quicker. We have a pretty large business, and we're only a team of 11, and that lets us do that. Our customer service is what we're known for. We're ranked as the safest CeFi lender in the country with the highest level of customer service with a team of 11 people. And it's because when you come to our website and you speak to us on chat, most of the time it's AI speaking to you. It's trained on all of our data, and 77% of conversations are handled by AI fully. All your questions, anything you need to do in the app are handled by it. So it helps us move a lot quicker. And it helps us answer questions that people have. A lot of people have questions around, hey, in this scenario, if I buy at this price, what's going to happen at this price? When do I get margin call? How much do I have to put up when I get margin call? All of that is handled by AI. We don't use it in our underwriting today, and that's because our underwriting is set with our capital partners. You can imagine the people we get money from are not exactly at the bleeding edge of technology. It's banks and credit funds and such that are very different from the people sitting in this room. And those people are still very much focused on the underwriting mechanisms that they have in place, and risk is the biggest factor for them. So that's something that will change. I think credit is going to change on its head completely. AI native investing is already quite big, and I think AI native credit investing will also be quite big, and we'll see new paradigms in that moving forward, but we're definitely not there yet.
So for you, it's making your business more streamlined, more efficient, able to do more with less people. But Steve, I've heard you say that for taxes and auditing, it's just going to make a lot of AI slop, right? That you have to go through as an auditor.
Look, I think there's a lot of low-hanging fruit in accounting that AI can help with, right? Whether it's compliance or filing, basic information, right? Like if I get a notice, let's say from Maryland because I owe them $4, like that goes to AI. The AI can handle that. But when you start to talk about high-value service, it's not something that you're going to be able to use AI for, because high-value service typically means you're making very big judgment calls, right? You're dealing in the gray. You're trying to figure out, is this or is it that? And you need a human to make that decision. I don't really care what AI gives me, and maybe AI gives me better data, maybe it gives me worse, I don't know. But if I have 5 data points that I'm getting, or if I have 5,000 data points, is it really making it me making a judgment call? Is the 5,000 data points better if I don't know where all those are coming from? Okay, so on-chain, when we think about AI, that's where I think it's going to have major impact, is when you look at on-chain, everybody's starting to use these AI agents on-chain to do payments and do trading algorithms and things like that. Now, how does the AI know when there's anomalies on-chain? So there was this situation about a month or two ago where the PayPal USD printed like 300 trillion stablecoins. You know what I'm talking about with this?
Yeah.
So if I'm an agent and I'm trying to use on-chain information to make decisions, they could have just destroyed the entire, ecosystem of on-chain, because how does it know that transaction's a mistake? If it got minted on-chain, that's like the GDP of the whole world, right? So if that occurs and I'm an AI agent on-chain and I don't have the ability to understand anomalies or understand what goes on, we still need a human there to make sure that that doesn't just destroy the world because somebody made a mistake. So same thing with what we do in audit. Audit is very based on trust and responsibility, independence, and things that people want human touch on, because at the end of the day, someone needs to be responsible for signing off on something. And when you start to allocate that down to computers and AI, what kind of world are we going to be living in? And maybe it happens. I don't know, right? But we'll see. But I think people will at some point start to revolt against it, because people want the social interaction of being next to another human. And I think that's going to happen with the generation of our younger children. Like my daughter's 2 years old, and I think she's going to realize that the phones and the technology is not her friend and is not something that she could rely on. And I think that we're going to start to get to a society like that more, where people are going back to where we were when you played outside and you had human interaction, because we're human. We're still social beings. So I don't know. We'll see.
And one last thing I want to highlight with you guys is that, we're talking about lending, we're talking about accounting. Those seem pretty technical businesses, but I think both of you pride yourselves in being white glove and high touch and being very connected with your customers and clients. So talk to us about how you focus on the client themselves in what you do on a day-to-day basis.
I think crypto as a whole has a huge issue of customer service and trust, right? If you go on a DeFi protocol and you do a transaction and something goes wrong, there's no one to speak to, there's no one to understand your concerns. And I think if you're dealing with large sums of whatever assets you've held and you've worked so hard to get, you really want someone on the other end who can, even if they're just there for support, for a conversation, someone to tell you that you're fine, or someone to fix issues for you. That's a huge difference. Our business is built on trust. It's not just trust in us, but also trust in how our technology works, how we hold your assets, the fact that we don't rehypothecate, the fact that we segregate all your assets and prove to you where they are. That's really important. So I think as much as the industry is very technologically advanced, when you're dealing with large sums of people's money, you still need a trust component. And I think giving people access to our team, giving people access to us as founders, and giving people access to all the information about their assets really opens up that framework where you know exactly where your funds are, and you can deal with us safely for a long term. We have clients now that are borrowed for us for 4+ years, and will continue to for the rest of their lives. And those people aren't dealing with us because of some technology, they're dealing with us because they know us. And that's what's going to continue to be a differentiator. It's very simple. In the traditional world, where you build a lot of assets, you go to a private bank and you say, here are all my assets, give me an account manager, and deal with me for the rest of my life. We're doing the same thing for Bitcoiners.
Oh, wonderful. And Steve?
What were we talking about here?
Being high touch with your clients, yes.
Okay, high touch. All right. Yeah, I don't know. You know, we do compliance services, right? We're an accounting firm, one of the largest in the country, and you know, if you talk to the top 10 accounting firms, every single firm would say, "Oh, we're white glove, we're high touch, we're the best." We do, and to be honest, that's not a differentiator anymore because that's what everybody says. And I think our differentiation is really being so specifically specialized in digital assets and the technology infrastructure that to me, I actually focus more on that of like, hey, if you're working with us, you're going to get the people that actually know the technology better than the competitor. And, you know, this whole white glove side of it, it really becomes a perceived value of the relationship. You know, for us, if it's like if I'm charging somebody a couple $1,000s to do a tax return, you know, who knows what that's really worth? It's worth whatever they think it's worth. So if we're able to provide, you know, service to them and value to them because they like me, that's great, right? But I also need to get it right. So I don't know. It's like a combination of we try to do everything we can, but we're also humans and we make mistakes, and you do the best you can.
Do the best you can. Well, while we still have a little bit of time, I'd like to open it up to the audience. If there are any questions in the audience, please feel free to raise your hand, and we'll be more than happy to address them. But if people are thinking a little bit before we have any, yes?
I think everybody's ready for some beers.
Yeah.
I have a question that may be appropriate to both of you. If you have Bitcoin, you're going to take a Bitcoin loan. At the end of that loan period, the interest would be due, whatever that amount would be. That has to be paid. Now, do you get to decide how that gets paid? For example, if you had a Bitcoin, and I don't know how to make the example, but if you owed, let's say, 0.1 Bitcoin in interest, that I would have to pay to the company at that point, do I get to choose where I pull that Bitcoin from? Because would it be better to like buy 0.1 Bitcoin at current market value to give to you as the interest and not incur a taxable event, as opposed to using the Bitcoin you already have, which may be old, which may have been bought at a lower cost?
So you would owe us interest and principal in dollars, not in Bitcoin. So when that is due, and you can defer that as long as you like.
So the interest is actually paid in US dollars?
So you give me, let's say you give us 100K in Bitcoin. We'll give you 60K in cash or in USDC, whatever you choose. And you can choose to make payments or defer till the end, whenever you choose to end your loan, which could be in 12 months, in 5 years, doesn't matter. And at that point, you can choose to either pay with cash or USDC, or you can choose to ask us to liquidate some of the Bitcoin in the collateral. So that's your decision. And obviously, there's different considerations around cost basis there. You could, if you really want to get creative, you could purchase Bitcoin, add it as collateral, ask us to liquidate that tranche because you have a high cost basis there, and we could do that as well.
Oh, I didn't even know that was an option. I didn't realize you could repay in cash. I thought it was a purely Bitcoin
It's a Bitcoin-backed loan in cash, right? Because even though you have Bitcoin as your reserve asset, you have expenses in the real world investment in cash.
Yeah, but if you transfer basis, if you have, let's say, 1 Bitcoin, you transfer to a loan, that transfer in kind is not a taxable event.
Right. But selling to cover the interest.
Correct, that would be taxable.
Right.
Cool.
One question. If your collateral gets
Jerry, there he is.
if your collateral gets liquidated, is that a taxable event?
Yes, it is. It's for the amount that gets liquidated. Keep in mind, we never do a full liquidation. So if you're at 80%, which is a partial liquidation event, we'll liquidate you back to 65, not the full amount. The goal is just to keep your loan healthy. Having said that, as I said earlier, you could get creative, and if you want to add some cash, we could convert that to Bitcoin, and then you have a high cost basis on that Bitcoin. But you maybe have something to add to
He's
that.
messing with you. He gets liquidated every couple years. So Jerry knows.
All right, 2 questions. This is first one's for my co-host Halston Valencia, big STRC maxi. Himanshu, you mentioned around the STRC trade with lending. Tell us a little bit about that. Second one is for you, Steve. I think it was yesterday. Somebody swapped $50 million in USDT for $25,000 in Aave. Massive, massive fat finger mistake. Is there any world where they can write that off into the future, or is that 6 years, or are they just wrecked?
I'll take that. I'm just thinking about that one. So, yeah, there's definitely a write-off to be taken there. I think we'd have to think about the loss and how it's characterized. I don't know really the detail of like what occurred there. Was it like someone stole it or what happened?
No, I think it's DeFi. So they
Yeah.
on one end of the spectrum of the trade,
Yeah.
$50 million in USDT.
Yeah.
On the other end, slippage. Where
It
the
was all
other,
slippage.
The other asset is $25,000
Jesus.
worth of Aave.
Yeah, it's a loss. It's a loss.
Like, is that for the rest of their life? They can just write that off, or is there
So
limitations?
again, there's certain rules on the characterization of the loss. Is was it a business? Was it a personal loss? I don't know, right? So that's there's different standards based on what happened there. If it was a business, they could probably roll it. It also depends. Was it an LLC? Was it a corporation? So there's a lot of questions I would have to give you that advice. But for the most part, it does roll forward, except with the exception if it was personal for certain states and things like that. They might have some restrictions on those things.
And then STRC.
Yeah, so for those of you who don't know, STRC is a product from MicroStrategy. It currently yields 11.5% annually, and it's somewhat correlated to MicroStrategy and somewhat correlated to Bitcoin, but not significantly, and that's by design. It's pitched as a stable yield investment, and a lot of people actually a lot of our clients are using their Bitcoin in an interesting way to get a risk-free return on the Bitcoin. So they borrow from us at single-digit rates. Depending on the size, that can be 7 to 9 to 10%. And then they invest that in STRC. So you can clip anywhere from 1.5 to 4% or 4.5% by making that trade, and you can keep looping that as long as you like. STRC recently increased from 11 to 11.5. We don't know if that'll happen again, but it's a very safe, interesting return. It's interesting because Bitcoiners tend to gravitate to STRC. The idea of investing in a stable cash flow return or a stable yield option is not new. People have been harboring this for years, for decades, I'd say. But now for Bitcoiners, this gets you a Bitcoin, somewhat Bitcoin-related, MicroStrategy-related product, which gives you a safe return. And at some point, when it gets to a par value, you actually can redeem for MSTR, which is very interesting.
Is it with that trade? I actually heard about this earlier this week. Do you also get the upside appreciation on the Bitcoin, or is it purely yield?
That's the whole point of doing a Bitcoin backed loan. So it's 3 tiers, right? You have Bitcoin, you borrow against it. The Bitcoin is sitting and it's appreciating. You use the cash that you borrow against it to invest in SCRC. You're making a risk-free 3-4%, whatever that number is, and the Bitcoin's appreciating at the same time. Now, where it gets really interesting is you just keep deferring your interest. You don't pay that at all, so you're completely efficient on cash flow. And at some point in the future, which can be when Bitcoin's appreciated enough, you can just liquidate some Bitcoin to pay off the excess interest, and you can end that or you can keep running it. In theory, you could run that for many, many years. And we have some clients that are doing it in significant size right now.
Yeah, but in Stretch, you're getting paid interest for allocating the assets, right? So when that interest comes, so the downside that I see on this thing here is that all that interest that comes in is obviously taxable interest at ordinary income rates, right? So every dollar that you're getting in off of that yield is getting taxed depending on how much you make at 30-40%, right? So you're really getting half. So then if you're reinvesting, you're really just banking on the appreciation of Bitcoin. And at that point, now are you just complicating Bitcoin? And this is the conversation I was having before. It's like all we're doing is creating financial paper on Bitcoin, and you're just complicating the product, right? But we're going to continue to build that, and that's what Strategy's whole model is that we're going to just create more financial product around Bitcoin.
I think that's true for any yield opportunity, right? You don't have yield opportunities that lead 40-50%. Yield opportunities yield single to double digits.
Yeah.
I think it's interesting for a lot of people that maybe are using it behind businesses and have other and have other structures. If that's your only investment, I probably wouldn't recommend it. But it's one part of a financial tool stack. I think you had a question there.
It accumulates in the stock, the interest.
Lowers your tax basis.
Interesting. I don't know. I don't know enough about it. I just found out about it earlier this week. It's a fairly new product, right?
Yeah.
Yeah, about 6 months old.
Yeah, I haven't looked into it that much.
Interesting because of that, because most dividends are not. And I think
Very weird.
A very interesting point with Stretch. Stretch is the biggest bid in Bitcoin right now. The whole reason we haven't gone down before 70, below the 60s and 70s, in my opinion, is because the bid from Stretch.
Yeah, they purchased 16,000 Bitcoin last
Buying
week alone.
$2,000, yeah, they're buying $2,000 a day right now.
Yeah, when it's
Wow.
hitting.
Question in the back. I hear it. I know you got one. I heard you.
I'll bring the mic over.
I don't want to embarrass you. We're friendly here.
Winston.
I was just wondering, when you borrow against your Bitcoin, what's the price to pay for borrow against the Bitcoin?
Yeah, it really depends on the size. You can go from as low as 7.25 up to 11.5%, and that depends on the size you're borrowing. Our rates are coming down in the next few weeks, so it'll be a little bit cheaper than that. But that's the range currently.
Okay, so like you have companies like Ledin that I think they used to have the custodial option. Are you custodial with the
So
collateral?
Ledin used to be fully rehypothecated. That's why they were at 10.5 2 years ago. They're now at 12.4 with the custodial model because we were fully custodial, never rehypothecated. They tried to model it after what we were doing. Our rates are just frankly much cheaper than Ledin's, and Ledin gives their Bitcoin to a capital partner to hold, which in some minds is considered rehypothecation. We don't. We hold all the Bitcoin ourselves. We're the originator, the collateral manager, and the lender.
So custodial or non-custodial? Because I can't hear you.
Fully custodial. All these lenders are custodial, but within custodial, there's two models. You can either hold the assets in custody, and you can prove to the borrowers that your assets are where they say they are, or you can hold the assets in custody and make the asset productive, which is called rehypothecation. Now, that is common in traditional debt markets. In Bitcoin, it's caused a lot of pain with the downfalls of Celsius, BlockFi, Voyager, and Genesis in 2022. And it's generally frowned upon today. We don't do that at all.
Okay, so as an example, or maybe it's not an example, if you held some collateral for a loan and it doubled in price, it appreciated. So say it appreciated back to like $125,000. You have the option of having us on your platform sell a portion through you to pay down that loan, because, for instance, Ledin does not allow that option.
We have that option, yes.
Okay.
You can do a number of different things. As Bitcoin appreciates, you can either take more cash out, or you can extract some Bitcoin out, or if you want to close your loan out, you can use it to sell a portion or all of your loan down.
We got 2 more questions. 2
back
more
here.
questions, and then let's go have some fun.
I think you mentioned earlier if you put up like 100,000, you get 60,000. So your LTV is 60%.
Correct.
That's better than most. Nice.
That sounded more like a comment. I love it.
Can either of you speak to the, what is it, 1099 DA?
Yeah, we
I know. Could you just kind of tease out that a little bit more?
You have a specific question on it?
I guess so. It's 1099 for. It's not for. It's just your cost basis. Is it if you sell, not if you hold?
So does everyone? I mean, a 1099 typically is done for brokerage firms that have equity transactions, and they're going to report to you basically your securities, whether you bought, sold, traded, etc. It's going to show proceeds and it's going to show cost basis. So essentially, gain or loss. 1099 DA. DA stands for digital assets. right? That is a new form that is being required by all brokerage firms, which are really just centralized exchanges. And this is the first year they have to report. Year 1 of reporting only requires them to report the proceeds, not the cost basis. So essentially what that's doing is it's kind of overstating the gains on everybody's 1099 DA because they don't know necessarily the cost basis. So if I bought Bitcoin, 10 years ago on, a random exchange, and then I transferred it into Coinbase, let's say, Coinbase doesn't know my basis in that Bitcoin, so they're just going to be like, okay, you sold Bitcoin this year at 120 grand. They're just going to send me a 1099 DA that says I made $120,000. But I could have paid 50 grand for that Bitcoin, and which means I really only made 70K. So next year, they'll be required to start reporting cost basis. However, I don't really know how they're going to do that because they don't have it in a lot of different scenarios. So there's going to be this kind of like seesaw for a little bit of time where they try to figure it out.
Thank you.
And then we have then you have DeFi, right? So once you get off to the centralized exchange, you go to the DEXs. I mean, they're not reporting. So.
All right, well, I know we have a few more questions, but I think that we'll be able to talk after this, right?
Absolutely.
Yeah, so we'll all be hanging out. We'll be around. We've got our wristbands. They go until 8 o'clock, so make sure you go out and use them. Again, this has been the Daily Stack's first Stack and Sip. Thank you so much, everybody, for taking part. It's been fun. We want to do this once a month. We've actually got T-shirts. We've got hats. Grab some swag. Take it with you before you go. And, yeah, thank you so much for coming out, and be sure to say hi.
Thank you.